Okay, hello everyone. Thank you so much for joining us today for our On the Mark Financial Forum and podcast. I am pleased to introduce to you a good friend of the team, my own personal insurance agent and insurance guru, Mr. Ed Kasser. Ed, do you mind unmuting yourself and just give yourself a quick introduction?
Yes, thanks, Mark. Ed Kastner, McGriff Insurance. I am the practice leader for our sports and entertainment group across the country. Been in the insurance business for about 17 years now. It seems like it gets longer and longer every day. So we'll see how we get through this.
Yes, I think our industries are aligned there for sure.
Yes.
Definitely getting gray hair, losing hair, all of the above. It all affects the hair for some reason.
Yeah, you got a long time to go, buddy. Look at this.
I'm working on it. But anyway, I really appreciate you coming today, Ed. You've been a wealth of information for myself and a lot of our clients, and there's a lot going on seemingly all of a sudden. Wow, what the heck happened? Give us a quick overview.
So obviously State Farm exiting the California market, or at least as far as new business goes on the property side. That's a big one, especially it being personal and commercial. Allstate had started doing that, I believe, at some point in time last year. I don't know the exact month. And then you're also dealing with, Pure tightening their guidelines, they're non-renewing a bunch of policies, AIG and what they've been doing over the last year to 3 years in California. Chubb tightening up. I mean, California's just one, right? I mean, and then we have Florida and what's going on in Florida after Hurricane Ian. To say it's a hard market is an understatement. I've actually never seen it where you literally have 3 or 4 states that carriers really don't want to be in right now.
Yeah, and that's a problem because most of those states are the ones where my clients primarily are. So that's why we wanted to have you on today is to enlighten people on what's happening, why, and what we can actually do about it to help our clients and navigate these challenges. So but it seems like the poor homeowners are getting hit hard with higher interest rates and now potentially higher premiums as well. So finding the right agent to help you navigate that is really important. So so maybe you can tell us a little bit in more detail, what exact changes are they making? I know State Farm is exiting the whole state, but there are other things that you're seeing that may not be a full exit of a state, but also just changing or tightening and things like that. So can you elaborate on that a little bit?
Absolutely. So we'll start with the high net worth carriers, right? So Chubb is now instituted where more states, they're requiring what they call non-cat premium. So if you look at Florida, Louisiana, parts of Texas, parts of South Carolina, California, brush prone areas, so parts of California, parts of New York, they're like, look, we may right there, but we're going to need a lot more elsewhere in non-cat prone areas. AIG's kind of pulled back. They're looking at different states and saying, okay, we'll provide a non-admitted product for that state to where we can determine what that rate is. And I'll get back to that at the end of this statement. Pure's actually going through doing I'll say a significant amount of non-renewals. They're cleaning up their book of business also in respect to where if clients had a water claim in the last 5 years, odds are they're going to get non-renewed. Vault's doing a cleanup. Vault was a newer player to the high net worth space. About 4 or 5 years ago, they came into the market, and now they're going through basically non-renewing about 35 to 40% of that book. And I know because I wrote a bunch of it and I'm in the middle of it right now. We have 9 right now that are coming up in July that we're working our way through right now that are non-renewals. So all the carriers are tightening, especially in that high net worth space, and they're doing it for 2 main reasons. And I think that's the reason why Allstate and State Farm have basically put a moratorium on new business in California, as well as other states. One is the reinsurance costs. So carriers are trying to clean up their book of business so they can get lower reinsurance rates to spread out to all their policyholders. The other thing is the offices of insurance regulation. So the regulators, whether it's California, Florida, or whatever, or whichever state, isn't allowing the rate increases that carriers need to be actuarially sound. That's easy for me to say. So instead of letting them take a 40% rate increase, they're like, we're not gonna let you do it. Fine, then we'll shut down. Because if you look at like State Farm premiums over the last 5 years, I would say they are way below what they should be for what their exposure is. So a 40% increase, realistically, in most cases, they should take a 40% increase probably for the next 3 years to become actuarially sound. But the Office of Insurance Regulation isn't letting that happen. The higher net worth carriers have had a little bit of a bigger play in that market. But again, that's why AIG is doing what they're doing as far as pulling out their admitted product, coming in with a non-admitted product, and the non-admitted product allows them to set the rates however they seem fit for the risk that they're looking at. So it's a very much individual risk base versus a zip code versus a state base, which a lot of admitted carriers go by.
So can you explain what a non-admitted carrier is and what the implications are if you go with that type of policy?
So yes, so a non-admitted carrier, certain states have, I'll say, default funds, right? Or like the Florida Guaranteed Fund. But they have a fund then where if the carrier goes insolvent, which has happened a lot in the state of Florida, if they go insolvent, then the Florida Guaranteed Fund steps in to pay claims, etc., up to a certain limit. I think that limit right now is either 300,000 or 350. I don't remember which one, but there's a guaranteed fund behind it. Non-admitted is if they go under, that's a you problem. In most cases, though, the non-admitted market are all AM Best rated carriers. If you look at like Florida and Louisiana and even South Carolina, a lot of the carriers aren't AM Best rated. Most of them are Demotech or KBRA rated, in which case you need to have a guaranteed fund behind it because, again, that's why they went under, versus AM Best rated carriers. Most likely, they're not going to default the way smaller, more regional carriers may.
Right. Yeah, that makes sense. It's kind of similar to the issue in the banking world with regional banks. You know, if you don't have the large amount of resources and you have some sort of financial shortcoming or issue, it's much harder for regional banks to absorb that. I would assume it's the same for insurance companies.
Very much so. And that's why when Irma went through in 2017 in Florida, that took a bunch out. They, you know, because they gave them 3 years to file claims, the whole 9 yards, and they kept trying to dig their way out of it and just couldn't do it. So, like I said, I want to say about eight carriers went insolvent, 4 sold to other companies, and then I think another 5 were basically just assumed. So
yeah, sounds like the banking industry, what that's going through right now, pretty much.
Very much so.
If you change the topic of which industry it is, you could say those exact words about the banking world.
Yes.
So, and just for the sake of context, and I want to make sure I understand this correctly and that the audience does as well. The way insurance companies make money is they issue a whole bunch of policies and hope that most of them don't have a claim, right? And they make money off of those people, which they then theoretically use to pay whatever the claims are. So if the claims are higher, that's where they become insolvent because they don't have enough non-claim clients to overcome all the claims that they're having to pay out. Is that an accurate assessment? I know it's dumbed down version.
So here's the deal, right? Let's say you are the insurance carrier, okay? I am the client. You insure my house. Let's say the premium's $3,000. Now you go and buy reinsurance to cover my loss in a catastrophic event, okay? So you go out and you buy reinsurance because if you're just doing a one-to-one, no insurance carrier is going to be made whole because it'll take, you know, one hurricane to wipe out. Well, right now, what are we at in the state of Florida? I think like we are between roughly 50 and 70 billion already in losses from that one event last year. So they buy reinsurance, okay? The reinsurance rates might say, hey, look, for that 3,000 that you're insuring, we're going to charge you $2,500 for that coverage on this. So now they're dealing with a $500. And then what happens is, and it's not just when there's a cat event, it's actually, I don't want to say better for the carriers, but what the part that really dwindles it down is when it's a bunch of water damage claims, little tiny claims that pick, and then, but they never tap into their reinsurance because it takes a catastrophic event for them to tap into their reinsurance because their deductible might be $10 million worth of loss in one event. So it's the smaller claims that happen frequently that have really, in the state of Florida anyway, and I'll say especially and in Louisiana, have really hurt the insurance carriers because their reinsurance isn't covering. Reinsurance is skyrocketing right now. The stat I heard on 1/1, the reinsurance rates, January 1st, the reinsurance rates went up 37%.
Wow.
So now if the carrier's taking a 37% reinsurance rate increase, what are they supposed to do? So
yeah, their margins are gone. There's nothing left.
Margins were long gone, right? They're paying you to insure your house, basically, or they're paying the reinsurance company. Yeah.
Right.
I mean, and
yeah,
you want the insurance company to be profitable so they can actually pay some claims.
Right. And as a homeowner, if you have a mortgage, for sure, you have to have a policy. So you're kind of stuck with whatever you can get.
Yes.
But one question I have for you is why now? Like what's happening now that is causing all these issues to bubble up? Because this wasn't an issue 6 months ago, a year ago, 5 years ago, or maybe it was, but it
was.
Yeah.
Yes, it was. Every carrier kind of did a little thing and it didn't become a big thing until again, lately, State Farm in California, because State Farm, I believe, is the largest insurance carrier in California. For them to do what they did was, again, that's monumental in that marketplace. So if you look at Florida, this has been happening for a while. I truly believe it is the reinsurance and the regulators trying to regulate affordable homeowners insurance are the two things that have kind of collided right now and have created this massive, hey, we need to lower our reinsurance costs. So carriers are tightening their guidelines. They're asking for rate increases. We've had, what was the stat? I want to say last year in 2022, there were more than 20 events that were $1 billion loss plus each.
Ouch.
20 of them. And that's not even counting the 50 plus billion, 70 plus billion that Ian's going to end up being. Take that one out. There's 19 losses that were all over $1 billion. I mean, whether you talk about climate change, you can talk about whatever, but right now, storms are becoming more significant. Brush fire is becoming more significant. Texas is now considered a higher brush fire state, which Texas was never considered a brush fire state. Now, all of a sudden, it's a high state. Colorado's now a high state for brush fire. All those places where you thought, it's not that bad. It's all becoming pretty tight from the reinsurance market. So,
yeah. And I was curious to know if, California's experience in particular experienced more rain than most years, let's just say significantly more. So I was curious to know if that means like the brush grows back, the wildfires may be worse, if that somehow maybe impacted this. Maybe that's part of the reason that the reinsurance costs more. Because they're kind of anticipating that this might be a really bad year for claims.
So California, actually, all the rain has really helped because it will take from dry brush to hopefully some green growth. And green growth can still catch fire, but not nearly as easily as dry plants. So that should actually help. The one thing California's seen this year is flooding and mudslides and all that it hasn't seen in decades, as well as the number of, I'll say, roof claims due to all of a sudden water coming in, and they're like, this has never happened before. I'm like, well, when's the last time you've gotten significant rain?
Yeah.
And they're like, I've lived here most of my life and I haven't seen rain like this. So even when you look at, the downpours that occurred in, I want to say like February and March, if I got the dates correct, those were significant rain events in California, which again, you're just not used to.
Yeah, no, it's definitely an unusual year for sure.
Yep.
Now, what about other areas that may be affected? I know Florida and California are two of the kind of hot ones that we talk about a lot, but what about like New York? What about the Hamptons, coastal areas, things like that? Are those seeing changes as well, or a pullback from the different insurance carriers?
Coastal is always one where I'll say over the last 10, 15 years, the carriers have kind of shied away from a little bit more. The Hamptons actually, it's gotten a little bit easier over the last, 6 to 10 years, which has actually been pretty nice. But again, it goes by the losses. I mean, Texas, to me, Texas was always really easy, other than like Houston area. And now all of a sudden that's going way more inland because of brush now in Texas. You look at Florida, California, Louisiana, South Carolina, they've all been bears. But now we're starting to see Texas, more, not just Houston area, but more of Texas be difficult to write in. I got a client right now. We've been working on got non-renewed by a high net worth carrier. We are now 7 weeks into this, and I've received 30 some odd declinations, and I'm still waiting on Lloyd's for a final option.
Wow.
I mean, and you're talking about 3.5. The house is what, like 7 years old, 3.5 million. You'd think everybody would want to write this. The house is nowhere near brush, but the property is, and they're just like that. That's a brush prone area, and I'm like, holy cow! I mean, it's just every risk, and we talk about in the insurance market, it seems like every single risk has hair on it right now, right? There's something that comes up. And so, yeah, it does matter. And that's where, like, literally, I might not have the solution now. Actually, I was talking to a gentleman last week, Joel, and I told Joel, look, that option that you're staring at right now is probably the best option in the marketplace. Wasn't even with me. And I'm like, take that option, go for it. And then that option went away because the first one was State Farm, and then came back with a second option. And I'm like, okay, look, between those two, here's what I would do. And I've spent more time advising, even if it's not a policy I'm going to be writing, only because the market's so difficult, and it may take somebody who's with a newer carrier or somebody who still has capacity that I might not be appointed with. So,
Right.
sorry, long-winded answer. I apologize.
No, but it's helpful context because it shows you what you might have to go through. And even if you already have a policy, it's not a guarantee that you're going to get renewed or that you're going to have an easy time getting a new policy. So, and usually, like typical supply and demand, if the supply of available insurers goes down and all these costs are going up for reinsurance, the premiums for sure, even if you can renew, assuming you can, which I would assume most policies are renewable in some capacity, but maybe not with the same insurer. But how much do you think this is going to affect premiums? Like, what should people expect over the next year or two? I know it's hard to say because different areas are probably different, but like, what are you seeing as far as cost increases?
So yes, the areas are very different, right? So if you look at Florida, 40% is pretty standard right now. Just because to become actuarially sound, and at least they're allowing the carriers to get it, based upon Irma and then Ian, it makes sense, right? If you look at the Midwest, I'm going to tell you right now, the Midwest, 10 to 15% standard. If you look at the semi-northeast, 20% is pretty standard right now. If you look at out west, like Arizona, Nevada, New Mexico, probably 15 to 20 in that ballpark. If you look at California, here's what I'm going to tell you. And if you're close to brush, we've had clients go from, on $8 million, they could go on an $8 million house, they could go from 20,000 to 200,000 in premium.
Wow.
Yeah, it's
Um,
because if the carrier says I'm out, now you got to go shopping, and that's what the rates are right now. I had a client who bought a $5 million house in Malibu, not down on the beach, which I'm like, look, for the cost savings on insurance, you probably could afford the beach house, but up on the hill with a beautiful view on 5 million, and his premium was 150,000.
Unbelievable. And if he has
Yeah,
a mortgage,
so
he doesn't have a choice.
the dollar rate is not out of the question, and now we're looking at $3 rate in tough prone areas, especially brush prone, because wind in Florida you can kind of stop. Brush fire in California, you don't stop. Brush fire in Colorado, you don't stop fire. You can help mitigate against it, but it's going to be a total loss, not a partial loss, and that's
Yeah.
the difference. Yeah.
Right. Yeah, that makes sense. Wow. Those are some staggering numbers for sure. And I know a lot of times people want to find ways around higher costs of anything, whether it be mortgages or insurance or whatever it may be. But one of the things, just projecting out, thinking in the future, I want to get your opinion. Do you think people are going to be now prone to maybe underinsuring their properties and not having adequate coverage because they're trying to mitigate the additional cost?
Seen it start to happen already. Yeah. As soon as State Farm went from 10 million max down to 5 million max, I'll say I had a client who was with Pure non-renewed. One of the options, I'm like, look, go look at State Farm. They were insured at 10 million, just a little above 10 million with Pure. They went with State Farm at 5 million. Because that was the max that they could get, but it gave them something at a lot lower premium. We're seeing two things. One, hedge your value, underinsure a little bit, or two, they're jacking their deductibles to try to save money. Now we're seeing carriers, do a 10% hurricane deductible. We're seeing, options on brush fire where some carriers now might be talking about doing a 20% brush fire deductible, similar to like their earthquake deductible. So I know that's in the talks, but yeah, everybody's trying to squeeze a buck here or there, and sometimes it doesn't make sense. I had a client who wanted to go from a 2% hurricane to a 5% hurricane deductible, and literally on $1 million, that's going from 20,000 to 50,000. And yet it saved him like $400. And I'm like, that doesn't make financial sense. I mean, it's $400. So it's not always, well, if I raise my deductible, I'm going to save a bunch of money. That is not always the case.
Right. And yeah, it'll be interesting to see. You started to touch on it briefly as far as like how the government gets involved. It's funny, whenever there's a banking crisis, the government gets involved. It sounds like there's insurance. The government gets involved, like they're trying to figure this out. So what do you see the government's role, and that could be state or federal, as far as how to try to help regulate the situation so the costs just don't continue to go up and up?
In California, I think the Cal Fair plan, which is like the brush fire policy, the Cal Fair plan, I think they're going to increase their limit quite a bit. I think they're going to go from a 3 million TIV. There's talk about them going up to a 4 or 5 million TIV, and I could see 5 million being the case.
What does TIV stand for?
Total insured value. So if you take the dwelling, some personal property, etc., Cal Fair plan, you're mainly looking at the dwelling in that case, and you're probably self-insuring most of your personal property. But in Florida, like Citizens quickly went from being the 12th, I want to say 12th to 15th largest insurer in Florida. Let's go back 5 years ago, and now they are now the largest insurer. Citizens is the state-run insurance product. Louisiana has their own Citizens. It was just announced last night that they're going to shift 10,000 policy holders over to Slide being a Demotech new company that will assume Citizens policies. So then if you get taken in the assumption then Slide's going to then put through their rate increase, in which case then you're going to go back into the regular market, but see your rates go up. Because the state-run programs really are supposed to be the insurer of last resort. But a lot of times people are shopping price, but the way the carriers are right now, I mean, most of the time, like I've probably referred, I don't know, 50 to 100 clients this year, not current clients, but clients who were either dropped for some reason, carrier went insolvent, that reached out to me and said, hey, look, Citizens is your option. I don't write with them, but go do that. Because I've dealt with Citizens and I don't write with them.
Yeah. Well,
Yeah.
it's definitely interesting times for sure. So what would you say, like, what can a homeowner do? Like, how do you navigate this? What recommendations do you have for how they should approach this, either if they have an existing policy or if they're a new buyer looking to insure a home that they're considering buying?
So two different factions, right? So if you're a current homeowner and you get a claim, other than a cat claim, right? So act of God, lightning, wind, etc. If you have a normal like pipe break claim, I would tell you, one, talk to your agent to see if you want to actually file that claim. If it's a smaller claim, I wouldn't file it, because anytime that there's a reason for them to come off the policies, or that's skewing the reinsurance algorithm, that becomes an issue. Right now, if you're a current homeowner, three things that I would do. One, make sure your house is insured to value. Do not underinsure it, because if you have a total loss, your premium, you might save $500 or $1,000 on your premium, but to save $1,000 to give up $200,000 on coverage doesn't make a lot of sense. But so, like, make sure you're insured to value. If there's areas you want to tweak, it might be personal property. You might want to increase your deductible, your AOP deductible, to go from, like, instead of 1,000 to 2,500. That might generate some decent savings. The big one right now we're seeing is auto water shutoff devices. And I talk about this a lot. An auto water shutoff device, and I'm just going to, Flow Logic is one that I know at the top of my head. I know Moen does one as well, but it's a device that you put in line going into your house as the water line comes into your house. And if the water's running when it's not supposed to be, it will automatically shut off. And if you get a good one, it will shut off and sends you an alert. If you have it attached to your centrally monitored burglar and fire alarm system, it will send an alert to the alarm company. Okay. These alarms run about $2,000, $2,500 to install, something like that, right? Carriers are now giving significant discounts or credits on the policy for this. Again, it becomes a big deal. I have a client in Miami who, I'll just say, his premium went from $6,000 to $8,000. If he installed one, it took it down to $7,000. $1,000 to install this unit, and in 2 years it's already paid for itself, or in 3 years it's paid for itself. Auto water shutoff devices are critical. Now, that's if you currently own your home, okay? If you're buying a house, I would talk to an agent and just go, hey, look, I'm looking to buy a house in Los Angeles. Are you really particular about the area? Well, kind of. Okay, here's what you look out for, right? So, like, if you're looking at like Palisades, or let's say even further in, right? Was it Calabasas? So let's say Calabasas, that area, those are high brush prone areas, right? If you're like, okay, well, let's try more of what's the one? Not Century City area. What's oh, come on, Culver City. So if you look more Culver City, not very high brush prone. If you look Newport Beach, like down near the water, we insured a client down there just recently, $3 million down there. Total premium was like $8,000. Had he been up in the hills, that premium would have been more like $48,000 for the exact same house, for everything. So location, just like real estate agents say. That term for real estate agents, location, means everything now in due insurance. as well as year of construction, depending upon the state. So if you look at Louisiana or Florida or any of your coastal areas, yes, year of construction is a big deal.
Yeah, and I wonder if, I mean, what you're saying, just based on the location within a city area could make a huge difference. I'm wondering if, in California, there's been, obviously there's higher mortgage rates. There's a new mansion tax that just went into place in LA County and surrounding areas. Now you have significantly higher cost of insurance. Like at some point, you wonder if it's going to start to affect property values in those higher density areas where fires are more common. So we'll see. That'll be interesting to see over time.
So in areas where flood insurance is basically where you're in high risk flood zone areas, take Houston, Florida, Louisiana, right, anywhere along the coast. Right now, if you have a flood policy that can be assumed on the prior rating versus the newer 2.0 that went into effect late last year, I think. But if you could assume the policy, that could literally save you $4,000 or $5,000 a year in flood insurance costs, because now they're just going distance to coast, and elevation matters a little bit, but now it's about construction, distance to tidal water, etc. But as you can see out in California now with the rains and mudslides, which most people don't realize those are floods, but private market flood with like Neptune and the flood agency is becoming more and more prevalent. And so we're writing more and more a lot of private market floods. But yes, being able to piggyback on a flood policy, being able to get lower insurance, to be able to, when you can manage those costs in a home, it makes a lot of difference if you're the seller, because then the seller can say, hey, by the way, you can get flood insurance at this rate. You can, based upon our year of construction, based upon the fire mitigation things we've done, here's what our insurance is. Now, just because that's what theirs was doesn't mean that's what yours is going to be.
Yeah, I didn't even know that there was an option to assume a seller's policy. That's a big deal. I mean, this is, and one of the next questions I had for you is what real estate agents can do to help their clients mitigate this. That would be huge. If you're on the listing side and and your seller can research whether their plan is assumable, that could be a huge selling point compared to other homes in the area where that might not be an option.
Yeah, and again, depending upon location. So like California, nobody's going to assume the fire policy, right? But flood is one that can be assumed. But it can make a tremendous, huge difference, especially if you're on a barrier island somewhere. And flood insurance now is going to run you, let's say, $17,000 to $18,000 a year, and they got a policy rated previously that you could assume for $1,800 or $2,500. It makes a big difference. Yeah.
What about does flood apply if it's like a mudslide prone area? Because I'm thinking like areas like Santa Barbara in California is very prone to mudslides, but I don't know if that counts as flooding since it's half water, half dirt. But
it's 100% flooding. Yeah. No, that's a flood event, which is why we're doing now more and more, I'll say preferred rate or X zone, which is low risk flood policies, only because we're like, wait a second, it's not just the coastals, it's not just the Mississippi, Delta, it's not the Great Plains that are getting flooded. When you start looking at North Carolina, Colorado, California, any kind of mountainous or hilly areas where there's going to be a lot of watershed and runoff, yeah, definitely recommend a flood policy. And those are normally really inexpensive, $400 or $500 a year, give or take the location. Right. Could be more, but again, depends upon location.
Yeah. So it goes in line with something that an agent can do to try to prep their home for sale, their seller's home, is to find out, like, are there any benefits that you can take advantage of with the policies? Obviously, the seller would have to research that on their own. The agent can't call the insurance company directly because they won't give them information, I'm sure, but they can at least advise their clients to check on those to see if there's any advantages that they can provide to offset that potential concern that people have about these higher insurance rates. So
to piggyback on that, Mark, I have insurance agents call me quite a bit that say, hey, Ed, how's this house? What does this look like? Just give me, I don't need a firm quote, but what are we looking at? And all of a sudden I look up. So like, if you look at like Louisiana, Alabama, anywhere in Florida, coastal South Carolina, coastal Georgia, all of a sudden they're like, by the way, how old's the roof? Oh, that tile roof is 35 years old. I'm like, no. And if you're going to buy it, put that contingency into the plan, being like, look, we might not be able to get insurance with a 35-year-old tile roof right now. We're going to need a concession for that because we're going to have to replace that within the first 60 days. And so they can use that as a bargaining tool or, hey, what does this look like from an insurance standpoint?
And I've seen that requirement recently on policies that I don't remember seeing in the past, where the insurer will give you a policy, but on the condition that you do certain repairs or add certain things or change certain things within a certain window of time. So can you explain what you're seeing there?
So yes, to help facilitate the market, some carriers will say, give us a signed contract, give us a start date. We will cover the roof at actual cash value, or the roof will be excluded until that's done, but you have 45 days to get that done. And once we have proof of that, then we'll add that coverage back on the policy. We've seen that more and more, and I've dealt with that a ton right now, only because somebody's selling their house, older roof, they don't want the expense of doing it themselves. They're like, we'll let the new buyers pay it, but everything's lined up at the time of sale. But yeah, some of the carriers, and then we go surplus. Obviously, standard market carriers aren't allowing for that, but surplus will. Yeah.
Yeah. I mean, I've seen it down to like a water heater being replaced, and like what seemingly little details. I'm sure they can cause more damage because they're full of water, but just things that you wouldn't normally think an insurance carrier would go into the minutia of. It seems like they are doing that now.
It's incredible because now they literally inspect every single house. Before they'd expect, the high value ones, and they'd inspect the older homes. Now it's every single house. Most carriers won't take a water heater over 13 to 15 years old. If it is, it better be replaced inside of the first 30 days that you own the home. That's normal. And that's become the norm. And that's been going on for about 2 years now across the marketplace, where it's like, how old's the HVAC? How old's the electrical? What kind of panels do you have? What's the updates? Do you have an HVAC contract? We got one carrier right now. They'll give you a discount if you have an HVAC, we call it annual checkup plan, right? Where they have somebody come out 4 times a year, like once a quarter, and check on it. You actually get a discount on your policy for that. Carriers are trying to do everything they can to mitigate against losses. And they know water damage like pipe break is the #1 claim in the country, right? You think brush accounts for more losses than even a hurricane across the entire platform. So when you look at it from that standpoint, water, which is why the auto water shutoff device carriers are given such large credits for.
Yeah. Wow.
Yep.
Lots and lots and lots of changes for sure. So it sounds like, if I'm recapping what you've said, as a real estate agent, talking to an insurance carrier about existing plans and talking to an agent like yourself about what plans are available is a really important factor, especially if you're in one of these higher fire zones or flood zones, because it could be a significant difference. And the last thing as an agent you want is for a buyer to back out because they weren't aware of some of these challenges. So whether you're an agent helping buyers or helping sellers, the timing at which you research these things is really critical. Because you were also mentioning in a private conversation we had that sometimes renewals alone or new policies are taking a lot longer to research because of all these nuances. So
Very much so.
In Bay Area, for example, you do closing sometimes in 3 weeks. So if it takes longer to get your insurance quotes, you're not closing in 3 weeks. So that's why it's really important to kind of start that process early.
Very early. And what's amazing is you could look at 2 houses within let's just say half a mile of each other. And that half a mile could be the difference between high brush and moderate brush, which means very difficult, very expensive to get insurance. And it's not that bad. I mean,
Right.
literally half a mile on the same street, half a mile down, if it's inside of a community versus on the outskirts, right? If you got a canyon coming up and you're on the outskirts versus a half mile in, two totally different ratings.
Right. And
Yeah.
what you've been highlighting is also, and this is not a sales pitch, but it just goes to show you can't just call Geico and get a quote. Like that's just not the nature of the beast. The lending world is very similar right now, where banks are not doing HELOCs anymore, doing weird things that normally they would have done. But you really need, in this type of changing climate, you really need an expert who understands all these things and knows how to navigate all the different carriers and the nuances of each individual home or apartment or whatever it is, and the location. Your expertise is definitely tremendously valuable. So I really appreciate you coming in today and talking to our group. And yeah, I think we're going to wrap up for today. But Ed, thank you so much for joining. And we'll look forward to seeing everybody on the next session, which will be a summer market update on June 28th. And look forward to seeing you all soon. And have a great day. Take care.